This has my next guest warning there could be still more upside to yields. Let's bring in Eric Johnston. He's Cantor Fitzgerald's chief equity and macro strategist. Great to have you here, Eric. Welcome.
Thanks for having me.
And what's the interplay between rates and the market, which, we've continued to see stocks come roaring back from their lows?
Yeah, I think with the reconciliation bill, I think it's a pretty big risk for the bond market. If you rewind 2 to 3 months, there was a lot of focus on how big the Doge cuts were going to be, and the fact that the deficit is in need of going in the opposite direction, starting to turn lower, and that was the direction we were going to be headed. And you saw bond yields go down to the low 4s. Now what's happening is bond yields are going back up, because if you fast forward to today, we're talking about a reconciliation bill that is likely to be at best keeping the deficit where it is, and in all likelihood have the deficit actually rise, especially if you look at the internals of at least the House bill, where a lot of the tax cuts in there expire in 2028. But will likely in 2028, of course, be extended. So the totality of the bill, I think, could cause upward pressure on rates. And then, of course, you have inflationary pressures that are coming from tariffs that are also going to play into that. Now, on the other side of the coin, we're likely going to see the economy slow down. And we've also seen oil prices come down.
Right.
So those do help the bond market. But I think the net, the risk from here is yields to the upside.
Yeah, we talked to Katie Stockton about this morning. She said she thought maybe 475 for kind of the upper end. So hopefully not too much higher from here. But even at prevailing levels, it's a problem for continued deficits and all that. Eric, I remember when we had you on a couple of months ago, it was before the big sell-off, and you had turned negative on the market. Are you still feeling that way, or are you more constructive now given all the price action we've seen?
So I think that the tail risk and the risk of a real big move lower has now been greatly reduced. And so I think right now, if I look over the next 3 to 4 months, I think we're going to be in a trading range. And I think right now we are at the very top end of that trading range. Institutions de-risked significantly in the month of April. They were the sellers, retail and buybacks were the buyers. So right now we're going through the process of institutions re-risking and getting on sides. I think a lot of that process is now behind us. I do think there is a little bit more in the coming, sort of week or so. But most of that is done. And then I think we've also gotten the good news of the first trade deal is now behind us. And then everyone was expecting the tariffs on China to be cut, not as much as they were, but that is now behind us. As we look forward, we have, slower economic growth, likely slowly rising prices over the coming months, and earnings estimates that have come down as we've expected, but we do think probably have some more.
Yeah.
So we've brought up sort of that big move down. We think is now highly unlikely, but we are at the top end of the range in our view.